Changes to mining taxes in Australia and the ANC's Sims document in South Africa has put the spotlight on mining tax. In the studio to talk to Mining Weekly Online about South Africa's current gold tax formula is Bruce Williamson of Imara Asset Management. Hi Bruce,
Morning,
thanks very much for coming into the studio. Can you unpack the current gold tax formula for us and sort of comment on whether it is a good tax or a bad tax in view of these calls for nationalisation and the impression that we get that the country is not getting its fair share from our resources?
Over time, the more I've looked at it, I really believe that our gold tax formula, which has been used in the industry for almost 100 years, really works. And there's a couple of important mechanisms that are built into the tax formula. I mean, one, you need to consider mines are generally, ore bodies are long life. They're not homogeneous. The widths and the thicknesses and the grades are not consistent from one mine to the next. So a flat tax rate is really difficult to see that surviving the test of time. Our formula has got important aspects to it, and one is the so-called tax tunnel, where at the moment, if your profit to revenue ratio is less than 5%, you do not pay tax. What that means is when a gold mine, which is desperate to keep spending, is not going to be hit with a 30 or 40% flat tax rate. And that gives them a little bit of leeway. As you progress and your profit margins move up, you will pay commensurately more tax. And then there comes a point in time in the formula, about 18% of profit to revenue ratio, you will now pay more than the corporate tax rate would have taxed you. And ultimately, as you move into so-called super profit level, you could be paying as much as 50% more than what the corporate. And that what that does is it prevents when commodity markets run and then suddenly politicians want their share and they call for the super tax. And that is the last thing you want, is the uncertainty and lack of integrity in a tax system. From a public and a government point of view, you don't want a mining company to pick the eyes out, i.e. to high grade and run away. What you want them at all times to be taking the opportunity to mine marginal ore. And that's what the tax tunnel does. So it's very efficient, as opposed to a royalty that is put onto revenue, which means you could pay tax when you're not even making a profit. So the formula is fantastic in that respect. It helps and assists in mining marginal ore, and you don't leave it sterilized where it's almost impossible later on in years to come to go back to marginal ore that you've left.
Has the state got much less, for instance, than the investor?
We've got 60 years of data which shows that if you take the gold industry in South Africa as a single entity, then about 67% of revenue is allocated to costs. Historically, up to 50% of that could have gone to paying wages, and there would have been an element of PAYE, i.e. the government would have received tax back. About 15% would have gone to capital expenditure. From a tax point of view, over those 60 years, the government has received direct tax of about just over 7% of the revenue was paid back to the government. And the shareholder, the one that everyone is nailing at the moment, would also have received, by way of dividends, about 7%. The government have received the same on a direct basis. And if you look at the linkages through the working costs, they have received far more. The forward and backward linkages through the capital expenditure and the working costs are great. Johannesburg is here because it started on the doorstep of the gold mines. Places like Carletonville, Klerksdorp, Welkom, Rustenburg. That is testimony to the fact that we have a formula that has allowed long-term vision, allowed these mines to develop, and yes, there's a lot of tax and subsequent benefits from mining expenditure and capital projects.
So what would your message be to the government today about 60 years of study here? Would you say to them we should keep this gold tax formula, keep the formulas that we've got, because they've stood the test of time, or would you look for some sort of changes to tweak them?
Take the formula, and over time there are issues. There's capital redemption with long-term mining projects. You need to allow mining companies to redeem capex 100%. If it's ultra long-term projects, you need an allowance on that to make sure that when you do redeem your capex, it's closer to money of the day. So there's always things to work around on the formula. But if you compare that to what the risk of a flat tax rate, it's stick with the formula and work around that. It has stood the test of time. It's going to be much better for the industry.
Can they go for the flat corporate tax or the formula? What is open to gold miners?
In the late 90s, gold mining companies who were on the tax formula, gold formula, were given the opportunity to cross over to, on a one-off basis, they could go back to the corporate tax rate or stay with the formula. Now, once you've made that decision, that is it. So we've got operations that are on either one or the other at the moment.
That was Bruce Williamson of Imara Asset Management, unpacking for Mining Weekly Online the elements of South Africa's gold tax formula